Larry Shover from Efficient Capital Management and author of Trading Options in Turbulent Markets is standing by at the CME in Chicago. Larry, welcome into the show. That strength in the greenback, short-lived, or is there consolidation on the cards? And therefore, what's it going to do to prices?
The prices of all commodities right now in comparison to the dollar, let's back up for a minute if you don't mind, but this whole thing is just driven by what's going on with the dollar, what's happened with the Obama tax extension, which our Senate just passed. Now it needs to go to the House for approval. The last 5 trading days, the dollar has reversed and gone higher against all currencies, including the Aussie, which was at parity just not too long ago. Commodity prices are depressed. Gold, silver, copper, all retracing. We have the ag markets down. Oil was up earlier in the day. It's down now on inventory discrepancies. It's really a little bit technical of a market. You see the S&P, the equity markets. We are on the verge of breaking our 6-day winning streak. The S&P keeps bouncing off that 1246 level if you're technically oriented. The support is down about 1225 right now. S&P's at 1233. It's a very complex market. A lot of moving parts with sovereign debt, with China, with all the things going on in our own sovereign debt states. Hard to tell.
Larry, this is David in the studio as well. If we're just looking at China, there's talk of them raising their local currency. What sort of impact is this likely to happen on commodity prices?
Well, there's 2 pools of thought on that. I think the majority of people think commodity prices, if that indeed happens, commodity prices will rally in 2011, especially the user-oriented commodities like copper, steel, so on and so forth. We're going to see right now in copper, it's a very interesting market. It's retraced on some technical factors. There's no real news out on it right now, but with what's going on in China for 2011, even with their inflation forecast of 5%, it's going to be there's going to be a big demand for copper.
And yet, it didn't, that commodity, get influenced in the same way as crude. We always think of copper as being one of those barometers for global growth. Is that still in play, Larry, or are you looking at another commodity into 2011 to set the tone?
Well, you know what I'm looking at right now is actually the option volatility of all the commodities. What's interesting is that most all commodities have retraced, as we all know. Option volatility has actually gone down quite a bit, and that tells me one of 2 things. Either we're in a short retracement zone or commodities are going to go back and rally soon in 2011. But right now, it seems like we're stuck in a technical range with most commodities. Will copper be a barometer? Hard to say. I think right now the biggest barometer is going to be the U.S. dollar.
Yeah, and until those European woes kind of come out of the system, it's going to be that constant pressure on it all. And of course, the buying action in Europe, that's crucial to underpin our future gains, if that is the case.
It is, and you know, I think U.S. politicians love when this news comes out, as bad as it is for Europe. The fact of the matter is, we have states right here in America with crisis levels far beyond Ireland, far beyond Portugal, or any other country that's having problems right now. And for some reason, those problems in California, Illinois, New Jersey, New York are all being swept under the rug. I'm fearful that when this stuff starts to peek its ugly head, that we're going to have problems in the market in 2011.
And does it all come back to housing? It seems that in spite of the drip of relatively good news outside that housing space, you look at the Home Builders Association there, they're looking gloomy.
Yeah, you know, our housing market, just like our unemployment market, our housing market has to turn around. And right now, over the last 18 months, the government has artificially raised the housing prices, but housing needs to improve for the economy to improve. And there's no indication of that happening right now. And no matter how cheap money is, if you can't get a loan, if you don't have a job, you can't buy a house. There's a lot of inventory out there. And until that turns around, our economy is just not going anywhere. And it's kind of foolish to a lot of people because they see the S&Ps making new highs and they're like, well, what's that all about? But generally, the S&P 500 is very commodity driven, and companies by and large have found out ways of how to be more productive with less people. That's the bottom line.
And that's the problem, because Barack Obama calls the top CEOs in for a fireside chat, as it were. And as you say, they go back to their companies and their investors who say, well, until we see demand, we're not going to green light you taking on more workers. You've just delivered some nice returns, as you say, on the back of that productivity push.
Right, and I hope he was hearing and I hope he was taking notes at that, because how many of us know small business owners that their employees are working full-time, overtime, but because of all the uncertainty in the United States with the healthcare regulation and other regulations that are down the pipeline, people just do not want to hire. And it's not like healthcare could go up 3%. It could go up 25%. And if you have 50 employees, that is a lot of money. And to be saddled down with extra employees that you end up having to terminate, that's bad news. So until that's figured out, until there's more certainty with what's going on here with healthcare, et cetera, we're not going to see any kind of turnaround, any kind of substantial turnaround.
All right, what are you watching for now, just in the hours ahead as well? I know you've got housing starts and the Philly Fed Index. Does the Philly Fed Index have to really mirror what we saw from New York? And if not, how will that gauge be any different?
Yeah, well, that Philly Fed number is always an important one, but I think it's priced into the market, and this is why I think it is. If you look at like the 10-year notes this morning, they rallied pretty substantially. Some say it rallied due to the sovereign debt problem, but I think it's more than that. I think they're pricing in these numbers to be feebly better, or a little wobbly, but getting better. And we had a late sell-off in 10-year notes today.
Still some talk of regulation when it comes to commodity markets, how you trade, the trading patterns, the balance between the ETFs and the retail investing component. How is that one likely to develop? Is it going to be just put in the too hard basket, or will they address it?
That's a very interesting question, because you don't hear a lot about the strangulation of speculation in our markets. Lately, we heard a little bit about the ETFs and the problems, the potential problems they could be for the markets. But the bottom line is, the U.S. and Australia and the rest of the world, we need a viable stock market. We need a viable commodities market. Buyers and sellers need to make price discovery, but we do not need a casino. I'm afraid with the regulation happy politicians that we have, they're going to do something that was close to the 1,000-day freeze of the Richard Nixon presidency, when he froze prices for 1,000 days. Next thing you know, it's going to be Lenin who is going to start prosecuting people for speculating in the markets. And if you want to go further back, go to Genesis 41, where Joseph took the food stores of the temple and had to sell them to the public. I mean, regulation, in the end, we need balance. We need some regulation, but the markets need to breathe as well.
Larry Shover from the pulpit, otherwise known as the CME Group in Chicago. Thank you so much.